All right, so here's how the structure is aligned. So we're gonna have the start of the day here. So this line here is the start of the day, the beginning of the day, right? And we know that we have three main sessions. We have the Asian session, the London session, and the New York session. The Asian session lasts for about 8 hours. So during that 8 hours, the market just bounces from support to resistance, going sideways like this, going sideways. Now, when we come to London session, when we come to the open of London session, let's say this is the open of London session, right? Let's say this is the open of London session. So now the market during that period, during that gap between the Asian and the London session, the market will tend to break out of that consolidation, right? So this consolidation lasted for 8 hours. Now coming into London session, we'll have a breakout out of that box. Now the problem now is a lot of breakout traders will look at this and see this as a confirmation to take the breakout, and then they begin to enter trades all up in here like this, right? So they begin to sell, right? Now what the market usually does at this point is the market will come back up, go back down, and then where do you think the stop losses of the people who took sells, these sells all in here, what do you think their stop loss would be? Now their stop loss is going to be above the structure. So if this was support, this would be where their stop loss would be, above the support like this. While some might put it here, but most people, a majority, so if like 100 people are selling this, like probably like 90% will put their stop loss here, right? So now what the market would do is they would come back in here like this, hit the stop loss of these people because of this is liquidity. So they go back, take out the liquidity, and then form an M formation like this. So now the problem with this is people see this as the market has entered back inside the range. So this is basically a fake out, right? So they now see this as a break and retest. But what the market tends to do is form a double top like this and then reverse and then continue back down in the initial direction, right? So now if you are taking sells here, you would have lost. If you are taking sells, you have taken buys in here, you would have lost, right? So at the end of the day, the market went in your direction, but this is called manipulation. They first manipulated your trades in order to make sure that you as a trader don't profit from whatever move they're about to make, right? Now how we're going to be trading this pattern is, what we're going to be looking for is, let me just clear this out. Now we have our consolidation, right? We have our consolidation during Asian session, right? So what we're going to be looking for is, we're going to be waiting for the market to break out of that consolidation. We're not going to take buys immediately, right? Or we're not going to take the breakout immediately. What we're going to wait for is for them to come back in here. Sometimes they will tap it, sometimes they'll come in a little bit like this, and then they're going to be looking to enter the trade in here like this, and expect them to continue up, all the way up like this, right? And then you put your stop loss below the structure and take this up. And the same thing goes for the opposite direction. You have your Asian session consolidation, forgive my drawing, and then you have the breakouts, and then you expect them to come back inside that range and then possibly give you an M formation. Sometimes it won't give you an M formation or a double top, or sometimes it just be like this, right? So you're going to be expecting this or this, and then you're going to enter the trade and put your stop loss above the structure. So now this pattern is basically, let's say the previous day they were coming down like this, and then they began to consolidate, and then they break down. So this is basically break of structure, and then they pull back, and then they continue down. So this is just your lower highs, and for the uptrend, your higher highs. So you're not gonna be taking this. You're gonna be taking this. Put your stop loss here and write it down. right? So that's basically how it works. I'm going to be showing you guys examples on how this works. I'm going to show you a couple of examples. I think a few came up this week. So let's see. So what we're going to do is, in order for you to have the daily markers, I'm going to go to settings on your trading view, right click and go to, so you're going to go to settings. So right click, go to settings and go to appearance and click on session breaks, right? So what this does is it separates each day from another. So this is going to be the start of the end of the previous day and the start of a new day and then end of a new day. So these are 24-hour markets, right? So now I also have an indicator that helps me point out the sessions and the Asian session considerations. So right off the bat, we have a beautiful example here like this. So we see that the market consolidated for about 8 hours. If you measure this, you'll see that this is about 8 hours from here to here. So this is 8 hours. So the Asian session ends. So there's a gap between Asian session, about a 2-hour or a 1-hour gap between Asian session and London and the start of London session. So now what we have here, we have the highs and the lows of Asian, and you can see they break out of Asian. So a lot of people will enter sales here and put their stop loss probably above the candle or inside this range here. Now what they do is they come back, take out all the people that took sells in here, and then they continue back down. So what you're going to be doing is, instead of taking the first breakout, you're going to wait for them to go back in and then come back below like this. And once they come back below, you take the trade and put your stop loss above the previous candle, or if that is too aggressive for you, you can put it above the structure, and this you would have caught about 40 pips on this trade. Let's look. Today we have one that's going on already. So we can see during that gap between London and Asian, we can see they break out of that consolidation and then they come back inside the range, break into the range and come back up. So you can take your trade here and put your stop loss in here. But right now it's the ending of the day, so you won't really have a volatile move. You can just take like maybe 20 pips off of here. And I think on USD there was a trade I saw there. Yeah, so on USD there was one that played out yesterday. I think even from Monday, yesterday, and not today, right? So on Monday, so you can see this is Monday. So you can see this is Monday on USD, Tuesday, right? Beginning of the week. So today's Wednesday when I'm recording this. Now on Monday, we had the same pattern. So you can see the consolidation. Now they break out of that consolidation. They enter back in, give us a hammer, and then they come back out like this. So you enter your trade in here and you would have caught about, let's see, 50 pips on this, or even more. Would have caught about 60 pips on this one. Now the next day we have the same thing. All right, so we have the breakouts. If you took sales here, you'd have gotten stopped out. Well, instead of taking the sales there, you wait and then you take the sales here, and you can see this went for about 50 pips too. So yeah, 50 pips is like the benchmark for these trades, to just look to take from 30 to 50 pips on most of these trades, right? So that's it for the video, and if you enjoyed the video, like the video, subscribe to the channel, and also check out the description. I put my Telegram channel in there, so if you're looking to learn more, consider subscribing to the channel and also to the Telegram, and I'll see you on the next one. Peace out.